steal Christmas. He just apparently pivoted to selling burgers because somehow, despite everyone saying the consumer is tapped out, McDonald's just posted their highest sales day in history.
Yeah, and sold 50 million pairs of socks.
50 million. That is a lot of socks. You are listening to Earnings Unscripted. We are breaking down what really happened with McDonald's Q4 earnings. It is February 11th, 2026.
And look, the socks are funny, but the numbers are serious. Revenue came in at $7.01 billion, effectively flat from last quarter. Earnings per share hit 3.03. It's a mixed bag, honestly. The top line is holding up because of traffic, but the bottom line is, well, it's getting squeezed. Net income is down 5%.
Just to keep the lawyers happy, quick reminder that this is not financial advice, just two friends looking at the numbers. So please do your own research.
Right. So headline comps, this is the big one. Global comparable sales up 5.7%. But the U.S. was up 6.8%. That is a massive acceleration from last quarter.
6.8 is huge, especially when you consider where we were 3 months ago, worried about the value wars. It feels like they won the value argument.
They didn't just win it, they weaponized it. They relaunched the extra value meals, they ran this Grinch campaign, and suddenly they are grabbing market share from low-income consumers again.
Which is, frankly, exactly what you want to see when the macro picture is this murky. But can we talk about the stock for a second? Because at 4 o'clock, the chart looked like a lie detector test gone wrong.
It was barely human.
Right? It spiked to, what, 330?
Yeah, 330, then collapsed instantly to 319. Just pure algorithmic violence. But it stabilized, ended the after-hour session basically flat. I think the market is trying to figure out if this traffic surge is sustainable or if it's just, sugar high from the marketing spend.
Sugar high or sock high?
Let's hope it's the burgers.
Fair point. But seriously, the traffic is up, but margins are down. That's the tension, right? They are buying the traffic.
Exactly. Operating income is down 6%. They're spending heavily to get people in the door. It's working, but it's expensive.
All right, well, let's see what that expense actually looks like under the hood. There's a lot more going on here than just Grinch socks.
Oh, yeah. The beverage strategy alone is worth a look.
Let's get into the details.
Right. And if you look past the wrapping paper, the most interesting shift here isn't actually the burgers, it's the beverages.
You mean the CosMc's spinoff, that alien-themed drive-thru thing? I feel like I saw 1,000 TikToks about that last quarter.
Exactly. And that's the trap. Everyone was watching the shiny new concept, waiting for them to announce a massive rollout. But then, on the call, they effectively pivoted. Instead of building hundreds of standalone CosMc's, they're taking the learnings, their word, not mine, and folding a new beverage lineup directly into the existing McCafé brand in the U.S.
Wait. So they built a whole separate brand, generated all that hype just to, clone the menu back into the normal stores?
Think about the unit economics, Susie. Why spend capital building 1,000 new boxes with new leases when you already have 13,000 points of distribution in the U.S. alone? It's classic efficiency logic. It's unsexy, but it's leverage. They're basically admitting we don't need a new chain. We just need better drinks to chase that $100 billion market.
Huh. So CosMc's was just a glorified focus group?
A very expensive focus group with purple drive-thrus. Yeah, but it makes sense. It signals they are done experimenting and ready to deploy.
Okay, but deploying costs money. If they're retrofitting existing stores or launching a massive new menu, who's paying for it? Because you said margins were already squeezed.
That is the big red flag for me. Look at the cash flow statement. They burned a massive hole in their liquidity this quarter. Cash and equivalents dropped from $2.4 billion in Q3 down to just under $800 million, $774 to be precise.
Oof, that is That is not a small drop. That's like a 60% haircut on their cash pile?
In 90 days. And debt crept up by $500 million, too. Now, some of that is buybacks. Sure, dividends, fine. But then you look at the capex guidance for 2026, they're ramping it up to almost $4 billion. $3.9 billion.
So, wait. Let me get this straight. Cash is down significantly. Interest expenses are rising, obviously, with the debt load. And yet, they are planning to increase spending to fund roughly 2,600 new openings?
Precisely. It's aggressive. It's basically management saying, we are going to build right through the macro headwinds. And frankly, it's a gamble. They're running the engine hot. If that revenue growth we saw in Q4 stalls, if the Grinch magic wears off, that cash cushion starts looking very, very thin.
It feels like they're betting the house that the lipstick effect holds up, doesn't it? That people will keep buying affordable luxuries, or in this case, affordable lattes, even if the economy wobbles.
Well, Kemchinski was pretty clear about that. He said, and I'm quoting here, McDonald's is not going to get beat on value and affordability. It's in our DNA. Which is great corporate speak for, we will engage in a price war if we have to, and we have the balance sheet to survive it.
Is in our DNA. Translation, we have deeper pockets than Burger King?
Essentially. But deeper pockets don't mean infinite pockets. Burning $1 billion plus in cash in a single quarter isn't something you can do 4 times a year.
So we've got a massive pivot back to core strategy, a cash pile that's shrinking fast, and a CEO promising to fight to the death on value. That sets up let's call it a tense start to 2026.
Tense is the word, especially when you see what they're predicting for Q1.
Oh, right. The weather. So where does this leave them heading into the rest of the year? Are they bulletproof or are they leaking oil?
Leaking? No. Skidding? Yes, because honestly, the immediate future looks like slushy.
You're talking about the weather warning.
Yep. January storms. Management estimates it's going to drag Q1 comps down by about 100 basis points.
So, classic weather excuse. It feels a bit convenient after a record quarter, doesn't it? Sorry we slowed down. Blame the snow.
It is convenient, but it's also a perfect hedge. It lowers the bar for Q1 immediately. So if they miss, it's the weather. If they beat, they're heroes.
Okay, so short term is, yes, soggy, but zoom out. What does this quarter actually tell us about the trajectory for 2026? Because to me, with the cash burn and the spending, it feels like they are stitching the parachute while jumping.
That's actually a good image. Look, the biggest signal buried in the report is that the restructuring charges, the accelerating the organization stuff, are now extending through 2027.
Wait, 2027? I thought that was supposed to wrap up this year.
Nope, they pushed the timeline, which means the efficiency costs are going to stick around. Combine that with the $4 billion capex plan we talked about. It tells me they are playing a very aggressive, long game. They are betting that if they build now, while competitors are scared of interest rates, they win the decade, even if they bleed a little cash doing it.
It's an aggression play disguised as a defensive stock.
Exactly. And the menu changes fit that too. Did you catch the protein forward comment?
I did! The unspoken Ozempic pivot.
Right. GLP-1 users want protein. Fine, we'll sell them chicken. It's pragmatic. They aren't fighting the trend. They are just, recalibrating the machine to feed it.
So, bottom line, how do you feel looking at this?
Cautious. The machine is heavy, Susie, and it's running on a lot of debt right now. But it's still the biggest machine in the world.
Fair enough. We'll see if it can outrun the weather next quarter. We'll leave it there before we get hungry.
Yeah, I could go for a coffee, actually. A McCafé?
Don't push your luck. You've been listening to Earnings Unscripted. All right, that's the tape. If you want these breakdowns to land in your feed automatically, just go ahead and follow the show. As a quick reminder, this is an AI-generated project where we pull the actual filings and transcripts to get you the signal without the noise. If there's a specific ticker you want to tackle next, shoot us a note at earningsunscripted@datamadness.ca. Thanks for listening, and catch you after the bell.